You're watching the Daily Market Comment by Mario Sajikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. Christmas came early for investors this year, with global equities charging higher and safe havens falling apart after drug maker Pfizer announced that the coronavirus vaccine it is developing was more than 90% effective in preventing infection during late-stage trials. Defensive assets such as gold and government bonds suffered, while riskier plays like stocks and crude oil thrived. The S&P 500 exploded higher to reach a new record peak, but there was a tremendous rotation within the stock market, away from stay-at-home tech winners and towards the most beaten-down value and small-cap names. It was a similar story in the currency sphere. The yen collapsed alongside the Swiss franc as traders trimmed their safe haven exposure, while commodity-linked currencies such as the loonie and kiwi shot higher. But as the North American session progressed, the incredible euphoria started to fade, and some of these trades rolled over, with the S&P 500, for instance, surrendering most of its earlier gains. There was no clear catalyst behind this reversal. Rather, investors may have realized that a vaccine probably means smaller stimulus doses from governments and central banks in the coming months and years. It all comes back to the bond market. Expectations for a stronger recovery imply the Fed might take its foot off the accelerator soon, which diminishes demand for government bonds and pushes Treasury yields higher. Higher bond yields, in turn, make everything else less attractive. In other words, the sharp spike higher in Treasury yields may have broken the stock market's rally and in the process brought the dollar back to life. Things are calmer on Tuesday, and the question now is whether this tidal wave of optimism can continue. The answer may lie with what signals we receive from Congress and the Fed about more imminent stimulus and how infection numbers and hospitalizations evolve from here. Finally, the Reserve Bank of New Zealand will wrap up its policy meeting at 1 o'clock GMT on Wednesday. Economic data have improved lately, but the bank could stress that the risks remain to the downside and reaffirm that negative rates are still on the menu. If anything, such signals may weigh on the kiwi slightly. This was today's Daily Market Comment. Thank you for watching at XM.com.